Hey guys, it's Sasha. The S&P 500 has gone up 18% so far this year. That's double the average annual return of the stock market in just half a year. So the stock market right now is growing 4 times faster than average. 2024 is already one of the best performing years in recent stock market history. And a lot of people will say that we're long overdue a major crash. According to these people, right now is the worst time to invest your money. An imminent stock market correction warning suddenly flashed red, says Forbes. A famed economist who called the 2008 recession shares 5 signs the US is on the brink of a downturn, says Business Insider. Morgan Stanley's chief strategist Mike Wilson warns the stock market faces a 10% correction, says Fortune. And then there's a random guy on YouTube who seems to be saying the opposite. Well, I don't own a crystal ball, but I have not been this excited about the stock market in a very long time. And I want to share the data that gets me very excited with you. And I apologize, some of this will get a bit nerdy because I prefer to make my investing decisions based on actual data science instead of studying tea leaf patterns or tarot cards. Now first, before we go into the serious data, I want to address the points that I hear being made over and over and over, including no doubt in the comments of this very video. People say, look at the data. See how the stock market has had these big red years on the left and we haven't had a few really big red years on the right more recently? Well, it means that the stock market is overheated. It means we are overdue a big correction or a crash or whatever. People say, look at the Buffett indicator. It is sitting at an all-time high. This is the ratio of the value of publicly traded stocks to GDP. And you can see that it is way above the historical average. So we're probably on the cusp of the stock market crashing back down. And then there's the Shiller PE ratio. It's at 36.2, way above average. And look, the last time it spiked like this was just before the dot-com crash, and the time before that it spiked just before the Wall Street crash of 1929. And look, it is spiking again, so you know crash is imminent. Go home, hug your loved ones, this is a disaster, it's going to be really bad, except the problem with all of this data is that people are really bad at interpreting and understanding non-linear trends. Humans are naturally very bad at processing non-linear relationships because our brains just weren't wired like that by biology. You plant 10 potatoes, you get 10 potato plants. You plant 100 potatoes, you get 100 potato plants, but it takes you 10 times as long to do it. If you do it manually with a sharp rod to dig the holes, all of this applies. Now, if you look at these charts again, here is the Shiller PE ratio chart. This chart shows the cyclically adjusted earnings from the previous 10 years. So what it does is it takes the company's current stock price and divides it by the average of the company's earnings for the last 10 years, adjusted for inflation. And according to all of these economists, it must follow that there is a flat trend. There is a median value here that makes sense over time. And if you go above that, then the market is too hot because the multiple is too high. But is that accurate? Well, the first ever Standard & Poor's index of US companies was made in 1923. Company valuations and trading data before this point is extrapolated and massaged to a point where it is highly unreliable. And if you consider all the available data since 1923, would you say that a flat line is the best trend line for the data in this chart? Or could it possibly look a bit more like this? Because as markets and technology mature, as the economy matures, as global economy matures, as life expectancy, things like that increase from 58 in the 1920s to 78 today, as there is more stability, could it be possible that it is completely natural for stock market valuations to gradually trend to higher multiples? Now, I would say yes, but the overwhelming economist consensus is that company valuations today, for some reason, have to work in exactly the same way as they worked 100 years ago. Same exact point for the Buffett indicator. Warren Buffett himself has said that he doesn't like this measure despite it being named after him. But do you think that this grey line is the best fit curve through this data, or could it maybe look a bit more like this? And looking back at stock market crashes, is it possible that all this greater stability, longer financial outlooks, longer investor timelines, less risk, fewer wars with extremely high casualties, much longer life expectancies, and therefore longer term financial planning, could all of that lead to fewer years where the stock market collapses as we go through time? Because if you were to employ that logic, it is very possible that we are, for example, in year 2 out of, I don't know, maybe 8 to 10 year streak of winning years as these red bars become more and more rare. But now, let's look at all of this data in a bit more detail. Here is a chart of the S&P 500 compared to Russell 2000. Russell 2000 is an index of small cap US stocks, and historically the two indices have performed very similarly. Actually, the small cap stocks have on average outperformed the S&P 500, but then came 2020, and suddenly small cap stocks got completely obliterated because smaller companies were less able to navigate the financial storms of the pandemic. They weren't as flexible, they didn't have the same kind of cash reserves, or well, at least that's what the stock market thought, and that's what's reflected in the valuations of those companies. Now, 40% of the companies in the Russell 2000 do not make a profit at all. They're unprofitable. A lot of these companies are early stage companies. Many of them just haven't reached profitability yet. Some of them maybe are reinvesting money into growth funded by venture capital and all that. But being consistently profitable is literally one of the requirements of being in the S&P 500. And it's perhaps not surprising that while many of the biggest companies in the S&P 500 have giant, enormous piles of cash, tens of billions of dollars sitting around on the balance sheet, many small caps instead have a big pile of debt. And so when inflation hit, the interest rates went up, the big S&P 500 companies started earning a lot of interest on all of that cash, which increased their profits. But small cap companies started paying a lot more interest on their debt, which had the exact opposite effect. So valuations on small cap stocks have plummeted, while valuations on big tech companies in the S&P 500 absolutely exploded in the last 4 years. Now, this chart from Wellington Management shows that small cap stocks have not been this undervalued relative to large cap companies since the peak of the dot-com bubble. While the S&P 500 is hitting new all-time highs every day, small cap stocks crashed 35 to 40% back in 2022 and are still today 7 to 8% down since before that crash. Even within the S&P 500, the same exact trend can be seen. Retail investors are busy focusing on only the biggest tech stocks. If you go on social media, if you watch YouTube, it's like there's only 10 companies that anyone ever invests in. Nvidia, Tesla, Google, Microsoft, Apple, Facebook, those kind of companies. And the reason everyone is obsessed with these stocks is because they are the biggest, their products are the things that people use and come across every single day, and their valuations are going up in a vertical line since ChatGPT arrived in November 2022. But look a little deeper within the S&P 500 and everything else is in exactly the same place as those small cap stocks. Airlines are trading at a P ratio of 5 or 6 with market caps lower than they were 10 years ago. Here is Delta, here is United Airlines, here is American Airlines, here is Southwest. Banks in the financial sector are still struggling to match their 2021 valuations. Here is Bank of America, for example. Here is Wells Fargo. Here is Capital One. Now, there are several different sectors that have gone nowhere. Some of them trading significantly below where they were, some roughly in the same place, but certainly trading at much lower valuations than these big tech stocks. And I'm looking at some of these valuations, and there are some absolute bargains out there. I've personally been shopping in the discount aisle. But here is what's coming next. US inflation is now done. It's over. It is at 3% right now as of the report that came out a couple of days ago. It is at 3% right now, and it is highly likely to dive down towards the 2% mark when we see August and September data come in over the next 3 months. The market is now saying there is a 94% likelihood that there will be a rate cut by the September meeting of the FOMC, because by that point, the inflation data will be overwhelming. So today, there is a 94% likelihood of the rate cut in September, but just 1 month ago, it was a 70% likelihood. And 2 months ago, it was only 50%. And, the election is coming up, so a September rate drop would come in at just the right time, wink, wink. But rates are going to come down now. And again, A lot of people in the comments say, Sasha, you're way too young to understand what interest rates looked like before they went to zero. And, I do appreciate the flattery. I am a little bit older than some people here might seem to think. My first mortgage was sitting at, I think, around 7%, and I was actually working for a big American bank as the financial crisis hit in 2007. I've been there, I've got the t-shirts, I was one of the ones walking out with all my stuff in a cardboard box like everybody else. Anyway, that's a story for another day. Just like with the data that we talked about before, people naturally presume that interest rates must revert back to some kind of a historic norm of 5%. People think that there has to be a one number flat line that applies historically across time, but here is the chart of interest rates over time. Once again, is a flat line at 5% the most logical, the most obvious way to draw a trend line here? Or do you think it could maybe look a bit more like this? Because, more maturity in the markets, more stability, all that jazz. And again, I would say that this kind of trend that is not flat, that is not linear, makes a whole lot more sense. If you're targeting a stable, flourishing economy with inflation sitting at 1.5% or 2%, you really shouldn't need to be sitting on interest rates of 5%. And in fact, if inflation was kept in check, lower rates stimulate more growth, which is good for the economy. And from September, it looks like rates are now heading back down. What do you think is going to happen to all of these companies that have seen their stock price collapse in recent years? What's going to happen to small cap companies who are paying a huge amount of interest right now on their debt relative to what they were paying before? What's going to happen to stock valuations? What's going to happen to market confidence? Right now, as I'm recording this video, we are 2 months away from that meeting when everyone's expecting the rates are going to be cut. Remember the panic in the stock market in 2022, at the start of 2022, in the middle of 2022 when rates started going up? I remember small cap stocks were losing 50, 60, 90% of their value because of this panic. And many of those have still not recovered. Well, there is every chance that we may see the exact opposite effect happen starting later this year. What happens as actually useful applications of AI start turning up in the market? Instead of Google suggesting that you put glue on your pizza in the search results, maybe Tesla finally has a breakthrough with full self-driving, an actually useful and transformative application of AI. The last 2 times when interest rates came down was a result of financial meltdown. They were the result of people trying to save the economy. But the time before that, interest rates came down without the economy needing emergency life support. Between 1989 and 1992, interest rates slowly made their way down from 9.75% to just 3%. There was a very brief recession in 1990, but the high inflation of the 80s was over, and so the rates did not need to stay high. And after the rates came down, the US stock market went on the biggest bull run in its history in the 1990s. At the time, it actually seemed highly unlikely. A lot of people, a lot of publications said that this was an impossible situation because the stock market had already had its strongest decade ever in the 1980s after going through the high inflation spike in 1980. But despite already growing by 200% from 1982 to 1992 when the interest rates came down, the stock market went and grew another 200% in the late 1990s. So which is it going to be? Is history going to repeat itself? Is the stock market going to go on one of the biggest bull runs in history as rates come down, as data suggests it could, or is this time definitely different?